Assalamu alaikum and a very good morning to all of you. Today is day 2 of the practice to pass session of this paper FA. In the last class, we had discussed about the topic that is incomplete records, and we were discussing about the topic company accounts. We have discussed the shares, the types of shares, types of share capital, the treatment of bonus shares, right shares, and dividend. And the last topic that was under discussion was the loan, stock, and bonds, in which I told you guys about the convertible loan, means the loan that can be converted into ordinary shares, and the loan is having a fixed face value or the par value. The interest on the loan, remember this point, that the interest on the loan should always be based on the par value. Should always be based on the par value of the loan. First thing. And the interest is dependent on the time actually. Suppose if you have bought a loan for a period of 8 months, then you need to pay the interest for the 8 months only. But if you borrowed a loan for a period of 1 year, then you have to pay the interest for the 1 year. The interest will be based on the time period. So here is a question for you guys. That was the assignment in the last class. I have shared some assignment with you guys. Did you have all solved these assignments? Has anyone solved the assignments which I have shared with you? No one? It's fine. I request you guys to please do attempt these mock exams, these assignments, so that it will improve your concepts. Okay, Moodle Limited issues 30,000. Now that's the par value of the loan. Each instrument has got a par value of 150, and the company is going to issue 30,000 instruments. And this is the interest rate, 10%. On 1st July, the end is 30th June. So that means we borrowed a loan and it's been almost 1 year since we borrowed the loan. So for the period of 1 year, we have utilized this amount of the cash, 30,000 into 150. So it will be 45,000. And for which you need to pay the interest of 10% for the year. So the interest will be 10% interest. It will be 4,50,000. So the interest amount will be 4,50,000. Now, even if this loan was issued below the par value, like the par value is 150, but the loan notes might be issued at a value of 100. So in fact, company has borrowed 3 million amount from this loan, but whenever you calculate the interest will always be based on the par value. The interest will be the same amount. So we have borrowed 3 million, but you have to pay the interest on 4500,000 because the par value of this instrument is 4500,000. It's 45 lakhs. I hope it's clear now. So in the income statement, the interest of 4,50,000 will charge as an expense, and on the face of the balance sheet, there will be a non-current liability of 4,500,000. Is it clear? Please write yes in the chat box so that we can go further. If you have any questions, any doubts, you can ask it immediately. Any confusions, please write yes or no in the chat box so that we can continue. It's clear. Now, attempt this part of the question. If the company has repaid 40% of the loan on 30th November 2009, then what will be the interest expense charged to the P&L? Loan notes accounting entry. It's very simple: cash debit or bank debit and loan notes credit 4,500,000. Now, please attempt this part of the question and calculate the interest that will be charged in the income statement. Did you solve this question? Now, I'm going to solve it. if the part of the loan, 40% of the loan note was redeemed on 30th November. Now, on 1st July, company has borrowed a loan of 4,500,000. And after how many months? July, August, September, October, November. After 5 months, company has repaid 40% of the loan. So what will be the 40% of 4,500,000? 4,500,000 into 40%. The amount will be 18 lakhs. So in fact, you have repaid 40% of the amount and you still have a liability of 60% of the amount, which is 2,700,000 remaining from the 30th November. So your year end is 30th June. So from the 1st December till 30th June, you have a cash of 2,700,000. So for the first 5 months, you have to pay interest at 10% into 5 upon 12 for the first 5 months. You need to pay the interest on 4,500,000. And for the last 7 months, you need to pay the interest on this amount. So what will be the final cost? It is 7 divided by 12. I want you guys to please solve with me and reply your answer in the chat box. For the last 6 months, the interest is 157.5. And the first 5 months, the interest will be, so it will be 187.5. So if the company has repaid part of the loan, then you need to calculate the adjusted interest based on the outstanding amount. So as we have repaid 1,800,000 on 30th November, so from the next month, our outstanding liability is 2,700,000, on which you need to pay the interest. So the final amount of the interest that will charge in the income statement will be 187.5 plus 157.5. Now, please give your feedback about this question. Is it clear to all of you? Is it clear now? Please kindly mention in the chat box. Is it clear to all of you? Okay, let's check the attendance first before moving on. Please write your name in the chat box and the city in which you live. Name and your city. Like my name is Samad Sarovar and I live in city Karachi. Write your name and city in the chat box. I'm just checking the attendance, that whether you people are still awake or in a sleepy mood. Ariba from Karachi, Tamil has from Karachi. Do we have only two students who are awake right now? The rest is sleeping. Write your name and the city in which you live. I just want to take the attendance first before moving on. Ahmad Hamad from Karachi. Any other student who wanted to share the names? From Islamabad. Okay. Why you people are responding very slow? Is it your fast that is affecting you? Believe me, these are very valuable sessions, and these will be very helpful to you guys if you take proper interest in the sessions and if you participate, in fact, in the question exercise. Because the questions that I have selected are very important questions from the exam point of view. So I request you guys to please do participate in the question answer process and respond on every question on this chat box. Secondly, the management will share my contact number with you guys. If you wanted to join our study group, you can join the study group for free, and where you'll be having exam support till the examination date. And I will give you some mock exams if you are appearing in the month of May in this paper FA. Now moving towards the concept of taxation. All companies have to pay the tax on the profits. So it is actually the company who have to pay the tax on their profits. So whatever the profit the company has earned, you need to pay a fixed tax based on the tax rate. So whatever tax, assuming if the profit for the year is 1 million and the tax rate relevant is 25%. So my tax for this current year will be 2,50,000. Now this is my just estimated tax. My actual tax might be different from this estimated tax. So what accounting entry we will make at the end of the reporting period? Tax expense debit by 2,50,000 and tax payable credit by 2,50,000. Remember this point, that tax will always be paid in arrears, annually in arrears. Means the current year tax will be paid in the next year, and the next year tax will be paid in the next year thereafter. So assuming it's a tax of 2020, then it will be paid in the period of 2021, when You need to pay that, make the accounting entry, tax payable debit and cash credit by 2,50,000. Now, at the time of the settlement, the taxation authority might ask you to pay 3 lakh rupees because they have their own calculation of the taxation. So you have booked the tax of 2,50,000, but they are demanding you to pay 300,000 rupees. So in this situation, you can say that your tax is underprovided. Underprovided tax. Underprovided means in the previous year, we have charged less tax than the actual amount that you have paid to the government. So in the income statement of 2020, you have booked a tax of 2,50,000, but you have actually paid in 2020-21 300,000 rupees. So your tax is underprovided in the last year by 50,000. Now what you need to do for this tax? This tax will be added in the current year's tax. So my equation should be tax expense is equals to current year tax plus last year's underprovided tax. Current year tax plus last year's underprovided tax. Similarly, if there is an overprovided tax, then it should be deducted from the current year's tax. So underprovided means that previously in the last year you have charged less expense than the actual amount that you have paid. So for the current year, you need to adjust that expense by adding in the current year's tax expense. Is it clear? I want your feedback. Is it clear to all of you guys? Wonderful. So now it's a time to attempt this question. What is the tax expense of 2009? Calculate the tax expense based on this question. So what should be the tax expense of 2009? Any answers? Is it an overpaid tax? Previously, you have charged a tax expense of 2,50,000, but actually you have paid a tax of 2,55,000. That means the tax is under provided, undercharged, under provided by 5,000. For the current year, the tax expense is 2,70,000 plus last year's under provided tax is 5,000. The answer will be 2,75,000. Now, is it clear to all of you? Okay. Okay. Double entry. Now, in 2008, the company will make an accounting entry of tax expense debit and tax payable credit, which is 2,50,000. Now, in 2009, when the company settled the accounts, they make an accounting entry of tax payable debit and cash credit. So there's a difference between the tax payable, which is 2,50,000, but actually we are paying 2,55,000 rupees based on this information available. So the difference of 5,000 will go in the income statement of 2009. Now for 2009, we have booked a tax expense of 2,70,000. So the accounting entry will be tax expense debit, tax payable credit, 2,70,000. So in the income statement, there will be two amounts. The one will be 2,70,000 for this year and 5,000 for the previous year's underprovided amount. So the total of 2,75,000 will charge in the income statement. Is it clear? Accounting entries? Underprovided entry is here. That's accounting entry for the underprovided tax. Now we can also make the T account for this taxation, having an opening balance of 2,50,000, my liability figure. The closing balance is 2,70,000. The cash that we have paid during the year is 2,55,000. Now you can calculate from the calculator that your amount will be automatically 2,75,000. So it will be 2,75,000. That is the adjusted amount of the taxation. Is it clear now? The ledger was distributed with the which one? Which one is confusing you? The tax one. I think it's very simple. Like your opening liability is 2,50,000. That comes from 2008. That's already mentioned here. The closing liability is 2,70,000. And during the year, the cash payment is 2,55,000. That would appear on the debit side. And the differential amount, the balancing figure will go in the income statement. I think it's a simple thing, but if you still have some doubts or you wanted to ask anything about this taxation account, you can ask me directly. Okay. Now moving towards the word equity. Equity means, always remember this point, share capital plus reserves. And what is the meaning of share capital? Share capital means number of shares into par value. Number of shares into par value will become the share capital. And the reserves. Reserves means restricted profits. These are actually profits, but these are restricted for the purpose of distribution of dividend. So at your level, there are 3 to 4 types of reserve that is commonly used. The one is the share premium. Share premium is the excess of the market value of the shares above the par value. Then we have got the revaluation surplus and some other reserves that we create for the company and retain earnings. These all are reserves account. So when we add reserves and the share capital, it will become equity of the business. So when we'll be studying the ratios topic, you will see that examiner might ask you to calculate the total equity of the business. The total equity of the business, whenever the examiner says calculate the total equity, you need to add the share capital amount plus the reserves amount. Now, we have covered almost all the key concepts of the company accounts that can be examined in section A, 2 marks question. Now we are focusing on 15 marks question. For the 15 mark question, you will be given a trial balance with some adjustments. And after adjusting this trial balance, you need to prepare the income statement and balance sheet. So now it's the time to that you will have a grip on the process of making the financial statements. So these are the basic adjustments that usually examiner might ask in the examination. Like there must be a compulsory adjustment of bad debts, then depreciation and revaluation, then stock valuation, accruals and prepayments and dividends. So these might be some compulsory adjustments. For final account question. Now starting from the bad debts. For the bad debt perspective, you need to know this thing that in the income statement, what will be go in the income statement and balance sheet. So you need to memorize this point that in the income statement, there will be a bad debt expense that we have written off during the year. That's written off. Add increase in allowance for bad debt, which is again an expense of the business, or there might be situations when there is a decrease in allowance. It should be considered as an income, so it should be deducted. Sorry. Less if the company has recovered some previously written off bad debt. So the answer, net answer will be your expense of the business. So the income statement, bad debts written off, increase in allowance, decrease in allowance, and bad debts recovered. If the net answer is positive, then it means there will be an expense in the income statement. If the net amount is negative, then it means there will be a credit in the income statement. Credit means income. You can also use the word charge for the expense. So examiner might ask you examiner might ask you a question in which the requirement says that to calculate the total amount charge in the income statement. So if it is mentioned that charge means that you need to calculate the expense. But if the question is saying calculate the total amount credit in the income statement, credit in the income statement means that you need to calculate the income amount only. Now, I want all of you guys to make the accounting entries for all of these 4 transactions. Bad debt expense written off, increase in allowance, decrease in allowance, and bad debts recovered. Please make an accounting entry for all these 4 transactions. Write your answers in the chat box. Very good. There are some students who have made the accounting entries. For the bad debt expense, the accounting entry should be bad debt expense debit and debtors credit. So whenever we write off the accounting entry, it will always go in the income statement. For increase in allowance, the accounting entry will be bad debt expense debit and allowance credit. For decrease in allowance, the accounting entry will be allowance debit, bad debt expense credit. And finally, when there is a bad debts recovered, the entry should be cash debit, bad debts recovered credit. This will be considered as the income of the business. Please verify your accounting entries with my answers. And if you have any confusion, you can ask it immediately. Now, what will go in the balance sheet with respect to the bad debts? When we talk about the balance sheet, we need to take the debtors at end after writing off all the bad debts, less allowance at end. The answer will be net debtors. So in fact, the net debtors are reportable or in current assets. Is it done? Now the net debtors figures, remember this point, will be reported in the on the face of the balance sheet. Now with respect to depreciation, you should know this that we can charge depreciation on the straight line method, or we can have a depreciation on reducing balance method. So whenever we are charging depreciation in straight line method, the formula will be cost minus scrap value divided by useful life, or into percentage. So these are the formulas that we use for the calculation of the depreciation. And after deducting the depreciation, we book the net book value, that is cost minus accumulated depreciation. It's called net book value. Similarly, when we talk about the reducing balance method, the formula will be based on net book value. Net book value into percentage. There's a huge difference between the straight line and the reducing balance. In the straight line, we took the value of cost less scrap value into percentage or divided by useful life. And in the reducing balance method, we need to take the percentage on the net book value. And net book value can be calculated as cost less accumulated depreciation. So now the key point that you should memorize or remember, after calculating the depreciation, assuming the depreciation of the business is 1 lakh, examiner might ask you to include 20% of the depreciation, the cost of goods sold, suppose 30% in administration expense, or 50% in distribution cost. So if the examiner tells you in the question that you need to distribute the depreciation expense under 3 headings, cost of goods sold, admin and distribution, based on the proportion, then you need to allocate it accordingly. Or it might be examiner might ask you to charge the full amount of the depreciation in the cost of goods sold or admin expense or distribution expense. So whenever you calculate the depreciation, then you have to see the policy that how the company is making the distribution of this depreciation expense in the income statement. Is it clear? Whatever key formulas or formats that I'm writing on the screen, I want you guys to please take the snapshot of these valuable tools so that it will benefit you in all the topics. So actually, we are covering the company accounts right now, but you knew it already that we have covered the bad debts topic, that is the part of FA2 as well, and it will be examinable in F3's paper as well. So we are completing more than 3 to 5 chapters at the same time. Company accounts, bad debts, depreciation, stock valuation, equivalent prepayments. Is it done? Yes. Now there is the concept of the revaluation. Revaluation means that you need to update your net book value based on the market value. Suppose my net book value is 5 lakh and the market value is 9 lakh of this asset. So what you need to do is to book the revaluation gain because the market value is higher than the book value. So there is a revaluation gain of 400,000 that will go in the equity. Accounting entry should be asset debit, revaluation reserve credit. Asset debit and revaluation reserve credit. Revaluation reserve is actually part of the equity. Similarly, there might be a situation in which a downward revaluation may arise. For example, the net book value is 5 lakh, but the market value is now 3 lakh. So there is a downward revaluation of 2 lakh which is called revaluation loss. Do remember this point that whenever we have got a loss, accounting entry will go in the income statement first. The accounting entry will be income statement debit and asset credit. So remember this point that the revaluation gain will be reported in equity and the revaluation loss will be reported in the income statement. Now the next adjustment is related to the stock with reference to the final account, in which you might be given a total stock of assuming 6 lakh, an examiner might ask you that part of this stock having a cost of assuming 10,000 was damaged and the revised net realizable value NRV of this asset is now 6,000. So according to IS2, inventory should be valued at the lower of cost or NRV. So my inventory is reported in the accounts at a value of 10,000, but according to IS2, inventory should be valued at the lower of cost and net realizable value. So its net realizable value of this stock is 6,000. Now, what will be the total revised stock? 600,000 less 10,000, because this asset is now having a worth of 6,000. Or even you can adjust 4,000 directly. So when we deduct this figure, my closing revised stock is now 5,96,000. Please do copy this example. And if you have any question in your mind, please do ask. I'm repeating this point that if the total stock is having a value of 6 lakh and examiner is saying that part of this stock having a cost of 10,000 was damaged, and because of its damage, the required net realizable value is now 6,000 of this asset. So IS2 says that inventory should be valued at the lower of cost and net realizable value. So now this stock should be recognized instead of 10,000. It should be recognized at 6,000. So what we have done, we have deducted the 10,000 from the 6 lakh figure and added the 6,000, which is the new value of this inventory. So my total adjusted inventory at the year end is 596,000. I hope it's clear now. Now moving forward towards the topic accruals and prepayments. Examiner might ask you to have accruals at the year end, or it might be a prepayment at the year end related to the expense. So if you have got the accrued at end, which was mentioned in the note, then the accounting entry should be expense debit. For example, this 10,000 and accruals credit. What does the accrued expense mean? That we have utilized the expense amount, but we have not yet paid the amount. Like we have used the electricity, but we have not yet paid the bill. That is called accrued expense. So do remember this point, that whenever we have got the accrual at end, it will always increase the expense of the business. So you can write this point that the accrual at end has got the direct relation with the expense and inverse relation with profit. Inverse relation with the profits. So accruals increases the expense and it reduces the profit of the business. Now with reference to the prepayments, the accounting entry should be prepayments debit and expense credit. So actually in case of the prepayments, expense will go down and the profit will go up. So even you can say that the prepayment at end has a direct relation with the profit. So prepayments should have a direct relation with the profit and inverse relation with the cost of goods sold. Please do copy this slide or take a snapshot so that we can move forward. Is it done? Okay. Even you can solve the issues of accrual and prepayment simultaneously if you have both accrual and prepayments balance in a single T account. Like prepayments is my asset, the opening prepayments will go on the debit side. Accrual is a liability, it will go on the credit side. So the amount of the cash that is the cash paid amount, and the income statement amount will be the balancing figure. This will be reported in current assets, prepayments. Is it clear to all of you? Okay, now moving towards the next slide. Now this is the format of the balance sheet. Always remember this point that whenever we are preparing the balance sheet, all type of tangible assets will go under one heading, that is property, plant and equipment. You don't need to report the land, building, motor vehicles separately. All types of tangible assets will go in the income statement. Then we can have investments in the non-current asset section and then intangible assets. Similarly, in the current assets, we can see that there might be inventories, receivables, prepayments, and cash equivalents. In the equity section, we'll be having a share capital plus reserves. And in the non-current liability section, we will be having a non-current liabilities and current liabilities. So this is the basic format, in fact, for the balance sheet that you need to follow. Now here we have got the income statement format. First we take the revenue, deduct it from the cost of sales. We got the value of the gross profit. Then deduct the distribution and administration expense. We got the profit from operations. Then we should add other incomes and deduct the finance cost. We got the value of profit before tax. Then finally, we have to deduct the tax expense. We got the value of the profit for the year. So remember this point that the name net profit word was obsoleted from the company accounts. So you need to follow this word profit from operations or profit before tax or profit after tax. There is no concept of net profit in business company account. And then finally you need to add or less the revaluation gain. Revaluation gain should always be reported in other comprehensive income. Other comprehensive income is not a part of profit and loss statement. It is a separate section that we have to report according to the requirements of IAS 1. So these all are the formats of IAS 1 that we are using. Now with reference to the statement of change in equities, we have got the share capital with all the plus minus values, share capital, share premium, Share premium balance with all the movements, revaluation with all the movements, and retain earnings with all the movements. So the closing balances of this statement of change in equities will be reported in the on the balance sheet. So first we prepare the income statement, then source sheet, and then finally balance sheet. Because the closing balances of all the statement of change in equity should be equivalent to the balance sheet figure equity side. I hope it's clear now. It's a time to do some practice. Opening a new file now. No, this is not a relevant file. Yeah, this one. It's a right file that you need to know. Now, I'm sharing with you guys a question. Now, it says that this is a type of MTQs that can appear in the examination. Do each of the following items belong on the statement of financial position as at 31st October 2007? So you need to report that which item which should be reported in on the face of the balance sheet at 31st October 2007. So you have to click on this drop down menu and select yes or no. You have this file with you, or if you don't have this file, you can download it from the handout section. The name of this handout is Day 1 Extra Practice Questions. So I want all of you guys to use your knowledge and select which item should be reported on the face of the balance sheet. Please do solve this question. You just need to select this question and select yes or no. I'm giving you just 2 minutes to solve this question. Yes, is it done? Or do you want me to solve this question? Okay. Now, first read the question again. The question says that do each of the following items belongs to the statement of financial position as at 31st October 2007. So the question is whether these items will be shown on the face of the balance sheet at 31st October 2007. So for the building, it's yes. For the accumulated depreciation, it's no. For the plant, it's yes. For the accumulated depreciation, it's no. For the bank balance, it's yes. For the revenue will never appear in the balance sheet. For the net purchases, it's no. For the opening inventory, it's no. For the cash at end, it's yes. For the trade payable at end, it's yes. For the receivable at end, it's yes. For the administration expense, it's no. For the allowance at end, it's no. For the retained earnings, it's no. For the equity, it's yes. For the share premium, it's yes. Now please watch these answers very carefully, starting from here. And if you have any confusion about this, please do ask. Any confusion in this question? No. Okay, now moving on towards this part of the question. Now the MTQs can be asked in different tasks. The first task is about the trial balance, in which examiner is asking for you about your knowledge about which item will go in the balance sheet and which items are related to the income statement. And in the task 2, it says that complete the following: the amount included in the profit and loss, sorry, the amount included in the profit and loss after the allowance is increased to 5% of the trade receivables. So in this part of the question, you need to calculate the allowance at the end. So you need to report the total receivables. You need to report, you have to make the double entries for the allowance for receivable. The first you need to check whether there is an increase in allowance or decrease in allowance. For this, you need to take the opening allowance figure. The opening allowance figure is 10 and the receivable is 320. Now take the 5% figure of 320. It will be 16. So if the opening allowance is 10 and the closing allowance is 16, so there will be an increase in allowance by 6. So what do you think should be the accounting entry for this situation? There is an increase in allowance of 6. The accounting entry should be administration expense debit, because it says that the allowance for the receivable is treated as an administration expense, and allowance for receivable credit. And what amount of the receivable figure is included? The amount included in the statement of profit and loss after allowance is increased to 5% of the trade receivable is, in the income statement there will be a 6 amount that will go in the income statement. As we don't have any bad debt expense written off during the year, so the total amount of the 6 will go in the income statement. Is it clear to all of you? Or if you have any doubts, you can ask it immediately about this question. Any questions about this task 2? Okay. So if you don't have any question, then we are moving forward. Now, solve this task 3. Plant is depreciated 20% per annum using the reducing balance method, and the building are depreciated at 5% per annum on original cost. Depreciation is treated as a cost of sales expense. The year in general for the building and the plant depreciation is given below. Using the information above, prepare the double entry by selecting the correct option of each row. So first you need to know the values for the plant. The plant is having a cost of 220 and accumulated depreciation of 110. So what will be the net book value of this plant? 220 minus 110. So it will be actually 110. And we have to charge 20% on the reducing balance method on the plant. So the 20% of 110 will be 22. So the depreciation expense for the plant should be 22. So what will be the accounting entry? as the question is saying that depreciation is treated in the cost of sales expense, the accounting entry will be cost of sales debit and accumulated depreciation of the building credit and accumulated depreciation of the plant credit. So the normal entry for the depreciation is depreciation expense debit, but as the expense is charged in the cost of sales, we can also use the head cost of sales directly. Debit and accumulated depreciation account credit. For the plant, we have calculated depreciation of 22. For the building, we are charging depreciation of 5% on original cost. That is straight line method. So the building is having a cost of 740. So the 5% of this figure will be 37. So the right answer of this question is 37. I hope it's clear now. Now we are taking a break of 10 to 15 minutes at maximum. And then we will cover the task 4 and 5 and other practice questions. So please stay connected. Right now we are taking a break of 15 minutes, and after that we will start the session again. Thank you so much. Okay, welcome back after the break. Now, today we are going to start the new topic, that is consolidation. So let's start with the topic, consolidation. Consolidation means preparation of financial statements of a group. Group means parent and its subsidiaries. We can have more than one subsidiary of a group, and there is no limit for subsidiary companies in a group. So how a company become a parent company and the second company will become a subsidiary company? When one company acquires the control of the other company, then the company who is gaining the control is called the parent company, and which is being controlled by the parent is called the subsidiary company. Voice is not clear. Let me check. I think it's clear from our side. Okay. The parent company control the subsidiary. Now how we can gain the control? Control means the power to direct. Relevant activities of the business. Now, who is going to control the subsidiary company? Whoever is called a parent company. And the control means the power to direct the relevant activities, means the power to direct the financial and operating policies of the business. So the company actually who is making the decisions, in fact, of the other company is called the parent company. Now, control is presumed when we have got more than 50% ordinary shares. When we have got more than 50% ordinary shares of the other company, then we can assume that we have got the control. So examiner might ask you the question in which company A has acquired 90% shares of company B. So whether B is a subsidiary of A or not, what do you think? B is a subsidiary of A or B is not a subsidiary of A? Any feedback? A company has acquired 90% shares of B company. Based on this, do you think that B is a subsidiary of A? So the answer is it depends on the factors. 90% which shares? has acquired by the parent company. If it is preference shares, so definitely there will be no control based on the preference shares. So even if you acquired 100% preference shares, you cannot say that company will be a subsidiary. The first thing is you need to identify that whether we have got 90% ordinary shares of the other companies or not. If you have got 90% ordinary shares, then you can assume that B will be a subsidiary. But it is also possible that you have got 90% shares of another company, but which is not your subsidiary. It is also possible. Because whether the company is your subsidiary or not will be depending on the word control. So if you have got 90% shares of the company B, but you have no control, assuming, then you cannot say that B is your subsidiary. But if nothing was mentioned, then you can use the percentage. That if you have got more than 50% shares and nothing was mentioned in the question, but remember this point, it should be ordinary shares. Then you can say that company B is your subsidiary. Is it clear? Now, company A, B, C. A is a parent company, B is a subsidiary, and C is also a subsidiary. This is my parent company, this is a subsidiary company, this is a subsidiary. So is it possible that A is a bank, B is a manufacturing company, and C is an airline? Is it possible in consolidation that the companies in the group are working in the different industries? What's your suggestion? Is it possible that the companies in the group are working in different industries? The answer is yes, it is possible. So the group members can have a different businesses, they can involve in different businesses, but whenever it comes to consolidation, you can consolidate the financial statements of different businesses. Is it possible that A is following IFRSs and B is following US GAAP and C is following Chinese accounting standards? Chinese accounting standards. Is it possible that the different group members are following different accounting standards? Yes or no? The answer is yes, it is possible. If the parent company is following the different accounting principles, which is IFRS, and its subsidiaries are following different accounting principles, then you can even consolidate that company. Similarly, if the parent company has a financial year from January to December, sorry, and subsidiary company is following a financial year of July to June, then April to March, so if they have a different accounting periods, then we can still consolidate these businesses. Okay. Now these are the areas that we are going to study in this topic, consolidation. Now the basic definitions. So what are the consolidated financial statements? The financial statements of a group presented as a single economic entity. We always assume when we're preparing consolidation that all the group members are single economic entity, like single company. The group means parent and its subsidiaries. A group can have only one parent. You cannot have more than one parent in a group. Subsidiary is an entity that is controlled by another entity. Parent is the one who is controlling one or more subsidiaries. Control is the power to direct the relevant activities. That's the key point. Now, this is again a different definition of control. Power over the investee. The first, you need to have a power over the investee. Exposure or right to the variable returns. Always remember this point that only the shareholder who has got variable returns from the involvement in the investee can control the company. Like we have already studied in the company account that the preference shareholders have got the fixed dividend. So the person who is getting the fixed dividend can never control the company. Only the person who is getting the variable returns. And you knew it already that ordinary shareholders will receive the variable dividend and preference shareholders will receive a fixed dividend. So preference shareholders can never control the company. And the ability to use the power is the third point. That is the requirement of IFRS 10. So these are the three basic points that we will use for the definition of control. Similarly, there is an other entity called an associate. An associate is a company in which we have got the significant influence. Significant influence means the power to participate in the policy making process. So in a very simple way, you can say that if out of 5 board of directors, we have got 4 directors. So our director is 4 in board of directors of 5 members. So you can say it's my subsidiary company because we are in the majority. Even if you have got 3 directors out of 5, then again, this is a case of subsidiary. But if you have got the 2 directors or 1 director out of 5, then you can say this is the concept of associate company. Because in the associate company, we only have got the significant influence. And significant influence means that we must have the power to participate. It's not necessary that you are going to lead the company, but you must involve in the policy making process and your representation in the board of directors is necessary. Is it clear? And non-controlling interest is the share of subsidiary company that was acquired by some other party other than the parent company who cannot control the subsidiary company, but they have got the shares. Like suppose if A company has acquired 80% shares of B company, so definitely there must be 20% shares of another company in company B. So based on the 80%, we are controlling and consolidating the subsidiary, but they cannot control based on the 20%, but they have the option to take the profits of 20%, but they cannot be involved in the decision making process. I'm giving you this question. Please attempt this one and reply your answers in the chat box. Now the right answer for this question is A. Let me check. The acquisition of the 60% of the Zactron company's equity share capital on 1st March, Zactron activities are significantly different. It doesn't matter that if the businesses of the parent and subsidiary are different from the rest of the world. So now this is my subsidiary company. The offer to acquire the 70%. Now this is just an offer. They have not yet acquired this company. Therefore, this will not be my subsidiary. The acquisition of 45% shares in which you have got 3 out of 10 directors. So this will be my associate company. The right answer is A. Very good. Any confusion to this question? Any confusion? Wonderful. Now attempt this one. Now the answer for this one is D. The answer for this question is D. So whether it is clear to all of you? Okay. Because the most important thing is that you have got lost the control. In all the first three areas, you still have got the control. See, Delta is located in a country where the local accounting standards are compulsory and these are not compatible with the IFRS. Like as we have discussed in the previous example, that if the accounting standards are different between the parent and subsidiary, then you still have to consolidate. There is only one situation in which you lost the control, then you do not need to do the consolidation. Now, write the unrealized profit. Write the formula for the unrealized profit. And accounting entries when the parent company sold goods to the subsidiary company, parent to subsidiary, accounting entries from subsidiary to parent. Make it accounting entries. Hello? दोस्त आ रहा है और सामान अंदर रखा ना अभी आएगा बैंक ले जाना है निकाल पीछे टाइम पे देंगे हाँ वो आ रहा है Now, in case of unrealized profit, the formula that we used is the profit of the transaction multiplied by percentage of stock still in the warehouse. And when the subsidiary company sold goods to the parent company, the accounting entry will be retained earnings debit, NCI debit, and stock credit for the unrealized profit. When the parent company sold goods to the subsidiary company, the accounting entry will be retained earnings debit and stock credit. So the concept behind the unrealized profit is whenever the subsidiary company has earned some profit, or the parent company has earned some profit from the subsidiary within the group, then that profit will be considered as unrealized or unearned. So we need to reverse that profit, because we are assuming that the parent and subsidiary company are one economic unit. So you cannot earn profit from yourself. So that is the reason we consider this profit, this is called intercompany profit, as unrealized profit from the group's perspective. Is it clear to all of you? Now, there is a concept of current accounting consolidation, in which if the parent company or the subsidiary company has got some debtors and creditors, like parent company has to receive 100 rupees from its subsidiary company, and subsidiary company is showing a liability of 100 rupees payable to the parent, then this will be considered as current account adjustment that you need to cancel out. Similarly, it might be an investment loan, like parent company has given a loan of 1000 to the subsidiary company has booked a liability of 1000. Investment loan should be cancelled out with each other. Similarly, interest receivable between the subsidiary and interest payable. So if you have got the interest receivable and interest payable, it will also be cancelled. So there we cannot recognize an internally created receivables and payables in consolidated financial statements. So if there is some intercompany balance, it should be eliminated from the consolidation, and if there is some profits that has been earned by the parent or subsidiary, then it will also be deducted for the purpose of consolidation. So this adjustment is called the current account adjustment. Okay, the next concept is about the cost of investment. Cost of investment means the amount that the parent company has paid to the subsidiary company for acquiring its shares. So it is actually the consideration that has been paid by the parent company to the subsidiary company when the subsidiary parent is acquiring the shares of subsidiary company. So this is called the cost of investment. Cost of investment can be in the form of cash. Accounting entry will be cost of investment debit cash credit, or it could be in the form of shares. So if the parent company has issued his own shares, the accounting entry will be cost of investment debit, share capital, and share premium credit. Is it clear to all of you? So the cost of investment could be in the form of shares or it could be in the form of cash. Any confusions, any questions about the consolidation up till now? I think no confusions. Okay. Then let's do now. First, we need to know that for consolidation purpose, we always calculate the goodwill. Goodwill can be calculated as the cost of investment plus NCI at acquisition plus fair value of net assets. Fair value of net assets. Cost of investment plus NCI into fair value of net assets. Now, cost of investment can be calculated by adding the cash consideration and the shares consideration. NCI can be given the question, or it could be number of shares of NCI multiplied by share price of subsidiary. So NCI can be calculated as the number of shares of NCI into the share price of the subsidiary. So can you calculate the NCI acquisition from this question? Zenda company. This is 9,000. Please calculate the NCI acquisition from this question. Now let's solve the question. Zenda is the parent company who has acquired 5,400 shares of Meta out of 9,000. So the difference will be NCI shares in the subsidiary company. So 9,000 minus 5,400. So it is actually the shares of NCI is 3,600 in the question. And each question is having a worth of 1.5. So it is actually 5,400 for the NCA. Now please tell me, is it clear to all of you guys that how we have calculated this NCA figure? Please ask any question if you have in your mind. Please, if you have any question in your mind, please do ask in on the chat box. Any confusions? Now, these are the important points for the purpose of consolidation. The first point is all the assets and the liabilities of the subsidiary should be measured at the fair value at acquisition. So actually we are acquiring the subsidiary company. So whatever company that we are acquiring should be measured at the fair value according to IFRS 3. Then all intangible assets should be recognized for the purpose of consolidation. We need to recognize all types of intangible assets for the purpose of consolidation. Contingent liabilities of the acquirer are recognized as provision for the purpose of consolidation, IS 37. Consolidation should be on the basis of control and not on the basis of ownership. We never do the consolidation proportionately. We always do 100% consolidation because once you have got the control, everything is in your domain. Then the final and the most important rule is the similar items should be merged and the intercompany balances should be cancelled. Is it clear whether all these 5 points are clear to all of you? Okay, now move on. Now, this is the format that we use in order to calculate the fair value of net assets at acquisition. Now, by adding the share capital of the subsidiary company, share premium, retained earnings at acquisition, then we need to add all the reserves and any other fair valuation adjustment in it in order to calculate the NCA at acquisition. This NCA at acquisition will be used for the calculation of the goodwill. Now you can see here is the formula for the goodwill on the screen. Please try to write this formula or take this picture of this formula that is a very important formula for consolidation perspective, because mostly MCQs was asked from the topic goodwill. So goodwill is one of the most important favorite area of the examiner. Please try to memorize this formula: cost of investment plus NCA at acquisition less fair value of net assets. We will got the value of goodwill at acquisition. Then if there is an impairment loss, it should be added back here, and this is called goodwill at reporting. Now, if the answer of this goodwill is in the negative form, then this is called gain from bargain purchase. Gain from the bargain purchase will go in the income statement as an income. Impairment loss is the loss. So this is the formula that we use. So I want all of you guys to solve the goodwill of this question. Wait. Now this one, please do attempt this question. Impairment loss is the loss that was suffered because of the decline in the business because of any reason. So if there is a decline in the business overall value, then you book an impairment loss according to accounting rules, and which will be recognized as an expense of the business. Now, example number 1, what is the treatment of negative goodwill? The answer should be so what will be the right answer for this question? The right answer for this question is B. Negative goodwill, as we have discussed earlier, like negative goodwill will be recognized as an income of the business, and all incomes will go on the credit side of profit and loss statement. I hope it's clear now. So I'm giving you a question in which you guys are required to calculate the goodwill. It's 315. Please solve this one question, and you are required to calculate the goodwill. Read this note first. Pepper valued the non-controlling interest using the fair value method, and for this purpose, the value was 2 million. It was already given to you, so you only required to use the formula for the goodwill and calculate your answer. The requirement is to calculate the goodwill. Yes, is it done? Now we are going to calculate the goodwill for this question. The cost of the investment is 19,000. Add NCI, which is 2,000, less fair value of net assets. The share capital of the business is 10,000. And do remember this point that you need to take the retained earnings at acquisition. Retained earnings at acquisition is 3 million. That will be 3,000. So total fair value of that asset is 13,000 out of 21,000. So amount of the goodwill that should be reported on the balance sheet at acquisition, which will be 21,000 minus 13,000. So goodwill at acquisition is 8,000. Then you need to deduct the impairment loss. As there is no impairment loss in the question, then the goodwill at the reporting will be 8,000. So today we have discussed about the definitions of the consolidation. We have completed the final account area and the basic concept of the goodwill. So in the next class, we will be covering the consolidated balance sheet along with the consolidated income statement. I want all of you guys to do the practice of day one handout. Now check this point that in the day one handout, you will be having a question with the name Miranda, in which you need to first make the trial balance, like share capital should appear on the credit side, share premium should appear on the credit side, retained earnings should appear on the credit side. So first you need to make a trial balance, retained earnings on the credit side, uh, inventory opening will appear on the debit side. So first you are required to make the trial balance, and based on these adjustments, all of you are required to make the income statement and balance sheet for this question, Melinda, and attempt all the MCQs available here. So this is the whole assignment that you need to cover. And in the next class, before coming to the next class, my request for you guys to make a plan that how you are going to pass the paper and at what date you wanted to pass the examination, because it's a revision session that the ACCA is conducting for you guys. So it's beneficial that if you are taking the regular classes and doing the practice, doing capital and BBPK, then it's good for you if you attempt the examination of this paper in the month of May. Don't stretch the examination date, otherwise it will affect your concepts or definitely your confidence as well. So make a solid plan for how you're going to pass this paper in the month of May, and I will cover inshallah the most important topics of the paper that are mostly examinable in the paper. And definitely I hope that this particular workshop is going to give you some benefits. I hope it is clearing some of your doubts that comes in your mind, or it is a golden opportunity for you guys that if you have a weak accounting concepts, you can ask me. I have shared my number with you guys. You can ask on the WhatsApp group. I've shared the link with some of the students. If someone has not yet joined the WhatsApp group, I request you guys to please join the WhatsApp group so that it will be beneficial for you guys. So thank you so much for today. Thank you so much for today. And we will discuss the further concepts of the consolidation and balance sheet and the P&L by tomorrow. So take care and do as maximum practice as you can. Allah Hafiz.